All right. Hi, everyone. Welcome to day 3 of the Fibonacci and Elliott Wave trading strategies event. This is Synergy Traders number 53. And this is brought to you by fxtradersedge.com, TradeOutLoud.com, and TimingResearch.com. So along with our long list of co-sponsors for this one. So we have another great day of education for you. And of course, just a reminder, all of these presentations are for educational purposes only. Trading is not suitable for all people. Please consult a financial advisor and only trade with money you can afford to lose. And as always, all of these sessions are being recorded individually, and they will be available on TimingResearch.com. And you can also find them if you search for Timing Research on YouTube, Substack, or your favorite podcast app. I've been running events now on Timing Research for over 10 years, and the full 10-year history of Timing Research educational events and shows are always available for you to review at any time. So today we get to start out with Aldo Lagrutta of ElliottWaveMadeEasy.net. And I'm going to go ahead and also TechnicalAnalysisInstitute.com. And so I'm going to go ahead and turn it over to Aldo.
Thank you so much, David. I hope that you guys all can hear me well. My name is Aldo Lagrutta. I am in Germany. I am a technical analyst and use Elliott Wave as my primary way of analyzing the markets. Today's presentation, I name it as Elliott Wave Made Easy because I've been trying to teach the Elliott Wave in the easiest possible way for the past probably close to 2 decades now. I have taught thousands and thousands of professional traders how to use the wave principle. And so today I'm going to try to give you the basics of it and going to try to make it in the easiest way possible. And the reason is because when I started learning the Elliott wave principle, I found it very complicated. I found it absolutely almost impossible to get. And with time, I realized that it wasn't that difficult. In fact, it's extremely simple. Now, simple doesn't necessarily mean easy, but we're going to try to do our best, okay? First thing that I want to mention is that we are all familiar with Fibonacci, the marvels of Fibonacci, the many uses that the Fibonacci sequence has on trading. And many traders speak about the advantages of applying Fibonacci. However, very few traders realize that the pioneer of using Fibonacci in technical analysis was Elliott himself. And the reason why I tell you this is because if we don't use the Fibonacci sequence, the Fibonacci numbers, and the Fibonacci, relationships, without the technical view of the Elliott wave principle, we tend to apply it in the wrong place, and that really take away a little bit of the power of the technique. So the only way to really apply Fibonacci's with proper, let's say, efficacy is by applying it with or in conjunction with Elliott wave principle, which is mainly based on the Fibonacci sequence. The Fibonacci sequence is very simple. It is said that Fibonacci himself started it with the number 1 and 2, right? Many people started with number 0 to try to be more complete, but Fibonacci started it with the first 2 numbers and said, well, the next number will be the addition of these 2. 1 plus 2 will be 3. And then every number thereafter will be the addition of the last 2 digits. 2 plus 3 will be 5. And then later we have 3 plus 5, that will be 8, etc., etc., etc. And you will notice that the entire wave principle is based on these numbers. You will see that the basic pattern is indeed based on these numbers. And I'm going to draw the basic pattern for you here. Okay, so you start seeing this. There are 5 waves going in one direction and 3 waves going in the opposite direction. What you have in front of you is the exact, let's say, basic pattern where everything of the wave principle is based on. So you see that there are waves moving in one direction. How many? 3, remember? 3 is one part of the Fibonacci sequence. And there are 3 waves moving the opposite direction. Remember, 3 was the 3rd digit of the Fibonacci sequence. Now, this entire thing gives us a lot of information. First, it tells us that there are 2 waves modalities. In the Elliott wave jargon, we refer to those Elliott wave modalities as motive waves, those waves that move in the direction of the main energy, the direction of the trend. In this case, it would be this one, and this one. And corrective waves. Corrective waves are those that move in the opposite direction of the trend. So we could easily name them trending waves and counter-trending waves. But the jargon is motive waves and corrective waves. And the way that we label the motive waves are with numbers. So this would be labeled like 1, 2, 3, 4, and 5. By the way, I didn't prepare slides for you because I found that it is much easier for people to follow my teaching when I'm drawing and showing them. And they are followed by something that we can label as A, B, C. You'll notice then that we are labeling the waves that are moving in the direction of the main trend. The motive waves, we're labeling them with numbers, and the corrective waves with letters. So now there are these 2 motive waves, and they form, or they are part, they become the building blocks of something much, much larger. In other words, we're going to, after this is the way that we identify the trend. This is the way that the market moves. This is the basic principle of the Elliott wave theory, where we have 5 waves moving in one direction, 3 waves moving in the opposite direction. And these become the building blocks of something bigger, in which we see 5 more waves moving in the direction of the trend, which is determined by the 5 waves, and followed by 3 waves moving in the opposite direction. And then the same thing happened again, 5 waves moving in the direction of the main trend, followed by 3 waves in the opposite direction. And if you look at this small drawing here, you will notice that it's a microcosm of the entire thing that I just drew there, right? So the entire drawing here, up, down, up, down, up, is the same thing at here, up, down, up. And the same thing here, the ABC down here, the same thing as here, ABC down here. So this brings the different, or the concept of the different degrees, right? So for instance, once that we label these 5 waves like this with these numbers, then we start labeling the larger degree, okay, with numbers that are in parentheses to show that they are from a larger degree than the components of its waves. And so right here would be the 2, but these 2 would not be like this one, right? Because otherwise we'll be confused what degree is which. So we put this one in parentheses as well. And then we have these 5 waves again, in which makes the 3rd wave here also in parentheses. And then we will have the 4th wave right here in parentheses as well. and the fifth wave here, which is the last wave. Each one of these waves will have 5 waves. And these 5 waves that are inside the numbers in parentheses will be, of course, the numbers outside parentheses. So this will be 1, this will be 2, this will be the third, the fourth, etc. And the same thing applies here, 1, 2, 3, 4, and 5. And the same thing applies here. The only difference with this ABC here is that this ABC is in parentheses. They are larger degree, right? And here it is. And these also become the building block of yet a much higher degree. We won't talk about the names of those degrees because it really doesn't really make any difference. It's just complicated names. But we know now what degrees are and how many waves are in each one of those waves. Notice that the motive waves always have 5 waves and the corrective waves always have 3 waves. So basically, the very first task, if not the only task, that an expert analyst has to do is to differentiate, is to learn how to recognize 5 waves versus 3 waves. Why? Well, because, we typically recognize a trend, or we define the trend by saying, well, an uptrend is a series of higher highs and higher lows. Well, exactly 5 waves here, right? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, etc., etc. But within the wave principle, we recognize that that definition is incomplete, and I'll show you why presently. At the moment, I just want to let you notice that we defined the trend in Elliott wave by 5 waves. If those 5 waves are followed by these 3 waves, in other words, if we have this 8-wave sequence, remember 8 was the number that came in this sequence, in the Fibonacci sequence, after 3 plus 5, 8. So if we have the 8-wave sequence, then certainly we can define the trend in that direction. Obviously, whatever I'm telling you here as an uptrend applies exactly the same as a downtrend, right? So if the 5 waves were moving down and the 3 waves were moving up, we will have an 8-wave sequence to the downside, and that would be a downtrend. So here we have the sequence of an uptrend. Here we have the sequence of an uptrend. Here we have the sequence of an uptrend. So when we have the clean definition that the 5-wave structure followed by 3-wave corrections give us for the trend, then our job is to differentiate when there are 5s and when there are 3s. And this is a lot simpler than it sounds when we see the markets. And I'm going to show you how, okay? Precisely on this chart. Here we have a move to the downside, down, up, down, up, down. So we label it as 1, 2, 3, 4, and 5. Among those, each one of these motive waves, the waves that are moving in the direction of the trend, should have 5 waves. And you can see in this case, you can see it very clearly with this 1, 2, 3, 4, and 5 for wave 3. Not all the waves, or the subwaves, I should say more properly, are visible in one time frame. Notice the difference here between degrees and time frames. Not all the subwaves of a particular degree are visible within a particular time frame. In this case, wave 3 is very clean and visible. Wave 5 may not be as clear, but with a little bit of effort, we could see here wave 1, a 2, a 3, a 4, and a 5. Wave 1 will be a little bit more complicated to see those 5 waves. Now, notice that these 5 waves are followed by what we think is a 3-way move, right? Which we label as A, B, and a C. So, should the market be here when you see these 5 waves down and these 3 waves up? Wouldn't you say that it would be very easy, very simple to determine what is the direction of the next meaningful move? And notice something. What we are trying to do with the Elliott wave principle, we don't see the future. We don't see what the market is going to do. The only thing that we see here is probabilities. Basically, we are trying to transform an ocean of possibilities that price offer us and transform that ocean of possibilities into a handful of probabilities. In other words, we try to, let's say, go from the feeling of uncertainty to probabilities. Okay, so what are the probabilities here? Well, we have 5 waves down and 3 waves up. What are the probabilities? Well, odds favor the downside. And notice what followed thereafter. Followed something that we label as 1, followed by A, B, C, 2. And then you can see the 5 subwaves to the downside. 1, 2, 3, 4, and 5. And notice what happened exactly after those 5 waves to the downside, but which, by the way, are to still a smaller degree than the one I showed you before. But this is just a way to label things. So don't worry too much about it. Just know that these small Roman numbers within circles are a lower degree to the single numbers. So we had here 5 waves clearly identified to the downside. So now, what should we expect after we get 5 waves down? Well, typically, we would expect a 3-wave recovery to follow, to continue with that, let's say, a pattern of 8 waves, right? So, and because of that, I am forecasting a little bit higher here before the dollar, this is the dollar index, continues moving lower. If we have 5 waves down here, we could label this as a 1 of something much larger, right? Which is in parentheses. I noticed that many of you were in the US, and yes, these type of numbers are European numbers. So this would be the 2 of a much larger sequence to the downside. And how do we know the sequence is to the downside? Well, because we have determined the trend as down. How did we do that? Did we say, well, there were lower highs and lower lows and lower highs? We didn't say that because, for instance, here we have highs, higher highs, higher lows, higher highs, and continue the sequence with higher highs, higher lows. And yet this is not an uptrend, right? So that's how we differentiate. And that's why I told you that that definition, although correct, is incomplete, because not always a series of higher highs and higher lows is an uptrend, just like in here. Okay, and not always a sequence of lower lows and lower highs is a downtrend. Okay, so basically, we had determined that we have 5 waves down and 3 waves up. That's an 8 waves sequence that determines that the trend is down and that the next meaningful move should be to the downside according to the wave principle. Now, could it be possible that our interpretation is incorrect? Of course, because as I said, what we are doing here is we are not seeing the future. What we are doing here is transforming a notion of infinite possibilities into a handful of probabilities. Now, what happened? What should happen after a 2? We have a 1, we have a 2. What comes next? Well, obviously, we will have a 3, right? So we all know this 3 would be in parentheses, right? That would be a 3 of that degree. It won't be this 3. This is the 3 of this degree. But these 3 should have 5 legs of a lower degree. In other words, 5 legs outside the parentheses. And that's what we have here. 1, 2, 3, expecting a 4 and a final 5 to complete that 3. Now, here is something that many people complain about the wave principle. They said, yeah, but it could be this and it could be that. Elliotticians always have an alternate count. And, well, that is true. And it is probably the greatest blessing that the wave principle provides us with. It's not the worst thing that happened. In fact, it's a great advantage. Because this 1, 2, 3 could be something else. It could actually be an ABC of a higher degree. It could be that this is an A, a B, and a C lower. But because we know that the structures of A, B, C's, they should have a certain number of waves as well. The guidelines and rules of the wave principle teach us what to expect. So if we were wrong, and this was not a 1, 2, and a 3, let's say that we were here, okay? And we have 5 waves down, 3 waves up, and we say, well, the next move should be a 5-wave move, and it's going to be a 3, or it's going to be a C. Well, what's the difference? Well, for practical reasons, known labeling. That's the only difference, because we know that whether it is a 3 or a C is going to move to the downside. And when we have those confirmations in counts, where we have 2 counts that are seeing things in opposite ways, because if we see this as an A, B, C, it means that the correction is to the downside, meaning that the trend is up. But if we see this as a 5, 3, 5, then we're looking at a trend as down. Therefore, we're looking at 2 opposing counts, yet both of them are looking at the same direction for the next meaningful move, which tells you that when we have 2 opposed counts that see the direction of the market in the same place, in the same direction, we have a setup that is worth taking. These are where the odds go in our favor, where we can trade with confidence, where we can trade with calmness, because we know that whether it is count A or count B, they're going to move in the same direction. And one of the things that we have that is phenomenal about the wave principle is that we know specific points where our counts, whether it is a wave 3 or a wave C, are going to be wrong, are going to be invalidated. Our interpretation is going to be either confirmed or invalidated. And we're going to get to that, to those specific points by learning the basic rules of the wave principle. There are many, many rules, and there are a lot of guidelines. But everything can start making sense and can be even applicable once that you learn the first 3 rules. And to learn them is extremely easy. We know that the market moves in 5 waves in one direction, right? The main direction of the trend. 1, 2, 3, 4, and 5. And so to address these rules in ways that you are never going to forget, what we're going to do is to make a sandwich of those, okay? Where this is the top part of the bread, and this will be the bottom part of the bread, and inside the bread, you know, this ham and cheese and tomatoes is going to be the 3 rules. And why I leave this like that? Because this is a way for you to remember to what leg the rule apply. So first rule is that wave 2 can never move beyond the origin of wave 1. That means that, well, let's say that we have wave 1, wave 2. Well, if it goes like this, if it moves 1 tick, 1 pip below the origin of wave 1, we cannot label this as 1 and this as a 2, because wave 2 can never travel 100%, more than 100% of wave 1. Then, next rule. That's the rule that applies to 2. Wave 2 can never travel more than 100% the distance traveled by wave 1. Then the next rule. Wave 3 can never be the shortest. So let's say that we have this situation. We have a wave 1, we have a wave 2, and then we have a wave 3, 4, and 5. Can we count this as a 5 wave? Well, no, because they don't follow the rule. Why no? Because, well, wave 3 of 1, 3, and 5 is the shortest. Therefore, we cannot consider that move, even though it's having 5 waves, it cannot be considered as a motive wave. And so that tells you that, yes, having 5 waves in one direction is not enough. Those 5 legs must follow the rules. And what are the rules? Wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest. It doesn't have to be the longest, but it can never be the shortest. And then finally, wave 4 can never end in the price territory of wave 1. What that means is that if we have a situation where we have wave 1, wave 2, and then we have wave 3, and then we have wave 4 and wave 5, these cannot be counted as a 5-wave move either, because wave 4 ended inside the territory of wave 1. That is what we refer to as overlap. Wave 4 overlapped wave 1. Okay, and there you have the 3 rules. A sandwich between 1 and 5, right? And where wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest, and wave 4 can never end in the price territory of wave 1. Okay, so now using these rules, let's go back to these counts that we had here, and let's check if they follow the rule. If they follow the rule and they pass, great. That means that we can label it that way and that we can count it the downtrend, and we can expect a next move to the downside. So first rule, wave 2 can never travel more than 100% the distance traveled by wave 1. You can see here, wave 2 ended below the origin of wave 1. Wave 3 can never be the shortest. You can see here that wave 1 is smaller than wave 3. And wave 4 can never end in the price territory of wave 1. You can see that it ended way below the end of wave 1. So can these labels be accepted? And the answer is yes. Therefore, we can label this as an impulse down. Let's say that we try to do the same as prices are moving, and we say here, well, this is wave 1, this is wave 2, this is wave 3, and this comes along, and what happened? We cannot label it as a wave 4 because it entered in the price territory of wave 1. It ended there. Therefore, it cannot be a 1, 2, 3, 4. And here is the basic thing to remember that makes things a lot easier for us in order to apply it to markets. If it is not a 5, it's a 3. If it is not a 3, it's a 5. There are only those 2 possibilities. So the moment that we see here this enter here, well, that eliminates the count as a, or this recovery as an uptrend, completely eliminated. Now we know we cannot, let's say that we were thinking, well, this is a high, this is a low, this is a higher high, this is a higher low, maybe this is an uptrend. No, we won't do that because this ended in the price territory of wave, of this suspected wave one, making it or invalidating this as a potential move to the upside. And what do we know? If it is not a 5, it's a 3. That means that we have to conclude that this move here is a 3, which means it's a 3 moving up, meaning that the trend is moving down. And therefore, we can expect a move to the downside. And now notice how these simple things, these simple rules, actually allow us to make sense of all these market moves. But not only that, but it also gives us those places where we can completely invalidate our view. For instance, we have here a 1, a 2, and then a 3. I'm talking about these single numbers, and we're expecting a 4. What happened that if, let's say, if I'm wrong, and wave 4 doesn't travel here to this 38%, you notice that I put a mark there, that's a Fibonacci retracement of 38%. What happened if wave 4 doesn't stop there? But this move, this recovery that you can see I was forecasting this a few days ago and was suggesting that prices were going to move higher. Now, what happened if they actually indeed move higher, but start moving higher, 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 and go inside here? Well, that would mean that this was not a 1, 2, 3, 4, and my interpretation was incorrect. At that point, we can easily say that was wrong. This is not a 5 wave in progress. It's a 3. Remember, if it's not a 5, it's a 3. And if it is a 3 that is moving down, meaning that the market is going to continue moving up. So now you notice that we have, with the 3 rules, we have the capability of determining if the trend is actually indeed moving in that direction and the precise point of ruin. And that means that we can actually use those points of ruins as stops. And I'm going to show you how. Let's say, using this chart, let's continue using this chart. Let's say that we wanted to trade this. We notice there are 5 waves here, and there are 3 waves up here. And remember, we have 5 waves down here and 3 waves up there. So we're expecting the move to the downside. So let's say that we were here and we wanted to move. We wanted the market to move to the downside, and of course we want to sell it. So let's say that we sell it here, right? Where do we put our stop? Well, based on the rules, if this is indeed 1 and this is indeed 2, the rules say that wave 2 can never travel more than 100% the distance traveled by wave 1, meaning that wave 2 can never move beyond here. So if I am selling this market here, this is going to be our stop, because at that moment, prices move even a single pip. It will completely invalidate our interpretation, and this can no longer be labeled as 1 and 2. So you can see that there is no system. Even though I love technical analysis, I've studied all its disciplines. I think they are all phenomenal. It's an entire universe that gives you phenomenal possibilities. None of the disciplines of technical analysis in the vast universe of technical analysis offers the exactitude of points of ruins, where to place the stops, as the wave principle does. So, okay, let's say that we went short there and we put our stop there. Guess what? We were not stopped out. Phenomenal. And now prices move in 5 waves down here. That's wonderful. It really encourages our position. It says, likely we are right. So now what do we do? Well, instead of keeping our stop there, now we can move it to the top of wave 2. Why? Because we know that prices cannot move beyond this level. Why? Because this is the wave 1 of a lower degree. And remember, wave 2 can never travel more than 100% the distance traveled by wave 1. Therefore, cannot travel above here. If it did, well, our count was wrong. Our interpretation was incorrect. Okay, great. Now let's say that we are where we are right now, okay? So where is our stop? Well, our stop should be here because prices cannot move there if we are in the downtrend that we believe we are. So that means that we enter short here. Now our stop is here, and we are waiting for the next move down. So you can see, let's make a drawing. Well, we have a drawing there. So when we trade, what do we trade in the wave principle, using the wave principle? What exactly do we trade? Well, we trade wave 3s, we trade wave 5s, and we trade wave Cs. Okay, let's see why. Okay, so we trade wave 3s because it is only after we have a sequence, an 8-wave sequence, that we can possibly forecast the next meaningful move with accuracy. If we try to do that before we have the 8-wave, or let's say the basic pattern, if we try to forecast the market before that, we are going to be guessing a lot. But once that we have the 8-wave pattern, now we have a sequence that determines the trend. So now we have 5 waves there, 3 waves here. Remember how I said that the first task of the analyst is to recognize between 5 and 3s. We see 5 moving up, we see 3 moving down, meaning the trend is up. So we're going to buy. So now we are going to buy here, let's say. Okay, so if we buy there, where do we put the stop? Let me see if I can have some of you guys the answer to that question, to see if you are following me, if you're understanding where we are in this sequence and how do we use it to actually trade. Say we bought here, where do we put, well, where do we place a stop? Well, since we have very little time, below the wave 1, thank you very much. So we put the stop right here. Okay, that is called a structural stop. That's why the stops that you can place using the wave principle are the only stops that really are valid. Other stops are guessing work. You know, people tell you, well, use money stops, you know, how much money you want to lose. Well, typically when we trade, we don't want to lose any money, but, you know, they say, well, if you are ready to lose $1,000, put $1,000 as a stop. Well, what if a stop of $1,000 is right here? Well, the market could easily do this and continue higher. And did it invalidate anything? No. Did it break any rule? No. Therefore, it continues going in your direction, but you are sat there, you know, lamenting that you lost $1,000 for no reason because the market came, stopped you out, and then moved in your direction. And that's what happened to all traders all the time. All the time we're seeing that, right? So the only way to avoid that is by using structural stops. We use the structure of the market to know exactly where we are wrong. Okay, now let's say that we want to, okay, we went long and we are here. Well, let's say that we exited here. Let's say that we exited a partial part of our position, and now we are in wave 4 and we want to buy again. Okay, so we buy here. let's say that we didn't buy exactly here because we were not attentive and whatever. Where do we put the stop? Let's see if you can tell me. Not going to wait too long because we have very little time. And I want to tell you a lot of things about the wave principle because the wave principle is the magical thing. Under 4? No, incorrect. If we buy here and we put the stop under here, we might encounter that we're going to lose because prices may continue down a little bit and go back up. The stop is here. Why? Under wave 1. Why? Because it is only then that if the market continues moving down, will invalidate the sequence. And we can no longer say 1, 2, 3, 4. Why not? Because it violates one of the rules. What rule is? The fourth rule? The fourth rule, no, the rule for wave 4. Wave 4 can never end in the price territory of wave 1. Right? So, and the same thing will apply when we have, I cannot move the thing, but when we have, let's do it this way. Let's say an A, a B, and a C, right? Let's say this big thing there. Same thing will apply there. We sell wave C, okay? We sell here. Where do we put the stop? Well, at the top of wave 5. Why? Because at that point, we will invalidate the ABC. ABC will no longer be the correct view, the correct interpretation. Okay, so those are the places where we would put the stops. Now, let me tell you now about the Fibonacci and how do we use them within this structure. Basically, what Elliott observed, actually, Dow had observed it earlier. And in fact, for those of you who are not familiar with it, the Elliott wave principle is actually, let's say, a refinement that was really needed for the Dow theory. Dow had observed that the market during the corrections tended to retrace a third or 2/3 of the previous move. What Elliott noticed is that depending upon was a wave 2 or a wave 4, they would retrace a different distance. So the way that we use the Fibonacci retracement, and by the way, is probably the one that most of you can use instantly because the other ones are going to be a little bit more complex and require a little bit more knowledge of the wave principle. But basically, this is the way that we use the Fibonacci retracements. Wave 2s tend to retrace 50 to 62% the distance traveled by wave 1. Now, this is not a precise number, particularly in the case of 50 is not even a Fibonacci number, but the retracement tend to go between 50 and 62%. Can they retrace a different thing? Yeah, of course, but those are the tendencies. Whereas the tendencies of wave 4 are to retrace only 38%. Hence, you could see here that in my expectations, I marked the 38 level there. Remember, I showed you earlier, I can't hear, you can see here is at 102.66. That's the level that I'm expecting prices are going to move to and be rejected from because, well, it's a wave 4. And by the time a wave 4 is spotted, many people have already identified the trend in that direction. So for instance, when prices are retracing on a wave 2, prices have been, let's say they were in a deep downtrend and they recovered. And what the people that were short here were expecting is that this recovery was going to be used to add to their positions. So when that happened, when they saw the market recovering, they added to their positions, and that pushed prices lower. And the reason why waves 2 then are moving down to 50, 62%, sometimes even 78%, is because there are more people selling the market at that point. But when they get to wave 3, the trend is identified by the majority of market participants. So what they are expecting is prices to move lower so they can buy and they can add to their positions. And that's why waves 4 typically don't retrace more than 38%, sometimes even 23%, the distance traveled by wave 3. And that is exactly the reason why. Okay, so now I have introduced you to all these motive waves and corrective waves. And now I want to tell you, it really sounds simple. I'm sure that you agree with me that, well, this sounded very simple. Can that be as easy to apply? Well, as I said before, simple not always means easy, okay? And what I find is that you need to know the different type of corrections, because I have drawn the corrections and shown you examples of the correction that are kind of ideal one. Yeah, that correction that I have shown you so far is called an ABC. It's called a zigzag. The thing is that there are other types of corrections. You see, in a zigzag, we have an A, a B, and a C. And these B tend to travel between 50 to 62%, that is traveled by wave A, meaning that in a zigzag, we don't get wave B to move beyond the origin of wave A. But there are other types of corrections that look pretty much like the zigzag. This is wave A, and wave B continues traveling higher and then move down. So this type of correction is again an ABC, but it's not called a zigzag, it's called a flat. And there are still other types of corrective structures that can be even more confusing, where prices don't come exactly in one direction, but they start moving like that sideways, producing something that resembles a triangle. And because of that, well, we call them triangles. And we label them as A, B, C, D, and E. So far, I showed you A, B, C's, but you can see there are A, B, C's, D's, and E's. Therefore, we need to get familiar with all these types of corrections. And there is something else that could make things a bit more complicated, and that is that all of these basic structures have variations. So for instance, we have zigzags that continue traveling like zigzags, making it double zigzags, like go like A, B, C, and then A, B, C again. So you see a zigzag here and another one here. Yeah, so this type of corrective structures are more complicated to identify. And again, we love doing that because it puts all the probabilities in our favor. But at the end of the day, we basically have to identify 5 structures, which is the 3 types of corrections, which is zigzag, flat, and triangles, and the 2 types of motive waves, which are impulses that move exactly the way that we have been discussing so far, and something that looks like a triangle. It moves like this. It moves like a triangle. You can actually put the lines like that as a triangle. But the difference between this triangle and this triangle is that this triangle is sideways. It doesn't go anywhere. Whereas this triangle, this type of triangle, move in the direction of the trend. So we don't call them triangles, we call them diagonals. And there are many examples of diagonals. The market loves doing them. So when prices move in the direction of the trend, when they move in motive waves, they can do so via an impulse or via a diagonal. Okay, and when they move in a opposite direction of the main trend, they can do it via a zigzag, via a flat, or via a triangle. And sometimes they can do that via a combination of them all. Okay, so for instance, you could have a correction that actually has a zigzag and then produces another wave that is another zigzag that connects with this flat, and then this flat connects with another zigzag that puts together the triangle and this zigzag. And then we see situations where the market is moving like that, going nowhere for weeks and days and months sometimes. And that's because the market is doing a complex corrective structure that, you know, sometimes it takes a while to recognize which type of a correction is it. And that's why our let's say our main obligation is to recognize or to differentiate threes versus fives. Okay, so now let's quickly see an example. I'm going to do this one, an example of a much larger situation. We have here 1, 2, 1, 2, 3, 4, 5, and you see how this fifth leg moves like a diagonal. You can see these two lines, right? They are connecting because they are a triangle that is moving in the direction of the trend, and that's a diagonal. Okay, so now we have 1, 2 of a larger degree, 1, 2, 3, 4, 5 diagonals, wave 3, 4, and 5. What does it tell us? Well, it tells us two things. The trend is likely to the downside, and the next move is going to be a corrective move. And notice what it did. It did a corrective move, but not in a zigzag, but in a flat way. See that how it resembles an N? And then you can see how I labeled it, A, B, and a C. And it was then where we had thereafter, where we have the 1, 2, 3, 4, 5 that we have been speaking about, and the A, B, C that we have been speaking about, which is a zigzag. I showed the example of the zigzag because obviously it's the easiest way. Okay, so now I'm going to walk you through another market so you can see the application of this, all right? And so you can see how, with the little knowledge that you have already, you should be able to determine what's the next direction of price. Okay, so let's go with this one because it's simple or it's obvious. You can see here, let me do it like this. Let me make it bigger. Okay, so let's focus on this part, okay? Let's make it like this. So we have a 1, 2, 3, 4, and 5. Okay, let's compare this against, or let's check them against the rules. Remember the sandwich, 1 and 5. Okay, they don't have anything to do. The next one is wave 2. Wave 2 can never travel more than 100% the distance traveled by wave 1. Did it do it? No, so pass. Wave 3 is the next one. Wave 3 can never be the shortest. Is it the shortest? No, wave 1 is shorter. Okay, great, pass. Next rule, wave 4. Wave 4 can never end in the price territory of wave 1, so it didn't produce any overlap, pass. So we have 1, 2, 3, 4, and 5. Great. So what can we expect now? Well, obviously, if we have a 5-way move in that direction, we would expect that the next meaningful move will be an ABC to the downside. The shape of that ABC, we don't know, but we do know that there will be an ABC that moves in the opposite direction of the main trend, and that we will label as an ABC. And this is exactly what occurred right here. Yeah, you can see down, up, down, an ABC. Where does this leave this market? Well, it leaves this market having an 8-wave cycle. And do you remember what we learned 55 minutes ago, when we first started this presentation? That the 8-wave cycle is the one that determines the trend. Therefore, it tells us that the trend of this pair is up, and we should expect prices to continue moving to the upside. And that is something that you can apply right away without more knowledge of the wave principle. Obviously, the more you study the wave principle, then you will realize that there are not only 3 rules. In fact, for motive waves, there are 11 rules. You will discover that there are not a few guidelines, but there are actually hundreds of guidelines. And all those guidelines guide us to do the proper interpretation. And all those rules prevent us from interpreting it the wrong way. And therefore, we need to learn those rules and guidelines, and of course, improve and improve. It takes sometimes, it could take weeks or months or even years. If you are slow like I was, you can take a long time before you learn that. Okay, so only 2 minutes to see if we can answer any question. Okay, somebody's asking where can see the replay. I think the answer is there. I think David will take care of that question. Anybody else would like to ask a question that I can answer in the next minute or two, so we can close the presentation and leave space for the next presenter? Where can we learn these rules? Well, one thing that you could do is to buy the book of Robert Prechter, where everything is stated there. The problem with that is that, from my experience, and that's only my experience, and as I said before, I was slow. I couldn't learn with the book, and I have seen hundreds, if not thousands, of people who told me that they couldn't learn with the book because the book is written for people that have a 235 IQ minimum. So I think you need a mentor. You need somebody who knows the rules, who knows how to apply them, and that's pretty much the easiest way to save time with this. Otherwise, it takes years. Need to see the replay. Is still too complicated. I apologize for that. If it is too complicated, it's because I didn't do a good job. This was hands down the most educational presentation. Thank you so much. Thank you for such a wonderful compliment. How do we get software and follow you? I don't know what you refer to software. You can follow me in YouTube. You can join my technical analysis institute /plus. It's a very, very inexpensive program. It's just a couple of dollars monthly, and you get weekly lessons. You get to ask me any question, and weekly I make a video answering all the questions. You get also important thing. You get in very deep discounts in every single one of my products. I have here I don't know if I change in that, you can see my screen, but this is the page, TechnicalAnalysisInstitute.com /plus. It's very, very little money, you can see, and you get basically 8 videos per month. I hope that answers your question, and you can ask any question you have. It works for anybody of any level. You can be a master Elliottian and still be there asking me questions. Okay, can you type the title of the book in here? Don't remember the exact title of the book, but I believe it was The Elliott Wave Principle. The author is Robert Prechter. I am a complete beginner. How can I start learning? Join this place, Join Plus.